I need to ask you something, and I want you to really think about it. If the market dropped 20% the day after you retired, could your retirement survive it? Right now in 2026, that question is not hypothetical. The market has been rattled. Oil prices are elevated. Recession probability, according to JP Morgan, sits at 35%. And a brand new study found that 67% of Americans are more afraid of running out of money in retirement than they are of dying. More afraid of broke than dead. And yet, most of those same Americans are counting on a retirement strategy that has a crack right down the middle. A crack that this market is making wider every single week. Today, I'm going to show you exactly what that crack is, walk you through the numbers, and show you what SCHD investors are doing instead. That completely changes the retirement equation. This is the most important retirement video I have made this year. Let's go. What the 4% rule is. Before we talk about the problem, you need to understand the plan that millions of Americans are using right now. It is called the 4% rule. Financial planner William Bengen developed this idea back in 1994. He studied decades of market data and concluded that if you withdraw 4% of your retirement portfolio in your first year and adjust that number each year to keep up with inflation, your money should last at least 30 years. The math looks like this. If you need $40,000 a year to live, you need $1 million saved. You withdraw $40,000 in year one. Adjust slightly for inflation in year two and keep going until you either reach 30 years or run out of money first. For a long time, this worked. It became the gold standard. The plan every financial advisor pointed to. The plan most Americans built their retirement around. But something has changed, and in 2026, that change matters more than ever. Here's the crack nobody talks about. The 4% rule requires you to sell your investments every single year to fund your lifestyle. Every withdrawal reduces the size of your portfolio. Your foundation gets smaller and smaller. Every single year you are alive. What happens if the market drops right after you retire? You still need your $40,000 to pay bills, so you sell. Even though your portfolio is down, you lock in those losses, and that money can never recover because it is gone. This danger has a name: sequence of returns risk. Imagine two people retire the same day with exactly $1 million each. Person A retires into a stable market. Person B retires into a volatile market, like the one we are in right now. 10 years later, person A is fine. Person B has run out of money. Same plan, same amount, completely different ending because of when the market moved against them. And it gets worse. The 4% rule ignores taxes. Pull $40,000 out of a traditional 401k or IRA, that is taxable income. After federal taxes, you might only take home around $30,000, which means to actually receive $40,000, you have to withdraw more than 4% every single year. Even Morningstar now recommends a safe withdrawal rate of just 3.9% in 2026, not 4%, because this market has shifted the math. And the deepest problem, the 4% rule was built for a 30-year retirement. But if you retire at 62 and live to 95, that is 33 years. The plan was not built for that. The math starts to break. So what do? The SCHD Alternative. What if you never had to sell a single share to fund your retirement? What if instead your portfolio sent you a paycheck every quarter? Automatically. Whether the market was up or down, whether you were watching the news or sitting on a beach. Just income, arriving like clockwork. That is the core idea behind building retirement income with SCHD. SCHD, the Schwab US Dividend Equity ETF, holds 101 companies. But not just any companies. Every single one must have paid dividends for at least 10 consecutive years and passed strict financial tests. 5-year dividend growth rate, return on equity, cash flow to debt. SCHD does not hold struggling companies. It holds proven businesses that generate real cash and share that cash with investors every single quarter. Right now, SCHD yields around 3.4%. Its annual fee is just 0.06%, 60 cents for every $1,000 invested. And since its launch in 2011, SCHD's dividend per share has more than doubled. From around 12 cents per share in its first quarter to around 26 cents by early 2026. Same shares, more money every year. With SCHD, you are not selling shares to live, you are collecting dividends. Your principal stays intact. When the market drops, your dividend still arrives. You do not sell low, you do not lock in losses, you collect your income and keep moving. That is a completely different kind of retirement security. Let me put real numbers on this. Under the 4% rule, $1 million, you would draw $40,000 in year 1. The portfolio drops to $960,000. Every year, you would draw more. Every year, your base shrinks. By year 20, your portfolio could be sitting around $300,000. By year 30, it's nearly gone. You made it, but just barely. And one bad market stretch early on could end the story much sooner. With SCHD, $1 million at today's yield generates roughly $34,000 in dividends in year 1, without selling a single share. Your principal stays intact, and if the market performs, it actually grows. And here is the power of dividend growth. SCHD's dividend has historically grown around 10 to 12% per year. By year 7, your income could be close to $70,000 on that same original investment. By year 15, over $100,000 a year, while your original million has also grown. One strategy is slowly shrinking your future. The other is quietly building it. Here is why this matters so much right now. We are in a market environment that is testing retirement plans in real time. Inflation is still running above target. Recession fears are elevated. Social Security confidence just hit its lowest level since 2017. The 4% rule under these exact conditions is under more pressure than it has been in years. Meanwhile, SCHD is up $13 since January. Why? Because when markets get uncertain, investors run toward quality, toward real earnings, toward real dividends. That rotation is happening right now, and SCHD sits right at the center of it. If you are within 10 years of retirement, this is the moment to take a hard look at your plan. Not next year, not when things calm down, now, because the time to fix the roof is before the storm, not during it. Here is what I want you to walk away with today. The 4% rule is not evil. It helped a lot of people, but it was built for a different time. A time without 3% inflation, elevated recession risk, and 35-year retirements. That time is gone. SCHD does not promise perfection. No investment does. But it solves the single biggest retirement fear Americans have right now, running out of money, by building income that grows every year while your principal stays protected. Stop shrinking your future. Start building income that lasts. If this video gave you something to think about, subscribe to SCHD, share it with someone who needs to hear it, and drop a comment below. Are you building your retirement with dividends, or are you still on the 4% plan? Smart investing, profitable results. This video is for educational purposes only and is not financial advice. Past performance does not guarantee future results. Please consult a licensed financial professional before making investment decisions. I will see you in the next one.